What I actually expect is the furthest thing in the world from a robust economy, globally and in the U.S. and in Canada. And it is very interesting that the stock market, for example, like, see what's happened here is that people, analysts, economists, strategists, have taken the stock market rally and fit in the narrative into it, that there's not going to be a recession. Everybody is thrown in the recession call. Part of that is reflected in this run-up in bond yields. And the Fed staff just threw in the towel on their recession call. So, look, I'll just say that the recession has been delayed, has not been derailed. Normally, it takes 2 years, actually, after the first rate hike by the Fed and the start of the recession. 2 years. They started hiking in March of 2022. So we probably have a bit more of a lifeline. This recession is staring us in the face, depending on your time perspective. We're not getting out of this without a recession. And then what's going to happen is you're going to have a huge default cycle. You're already starting to see it in auto loans. You're seeing it in credit cards. You will see it across the gamut. What have the banks been doing? The banks have been raising their loan loss provisioning. As you get Brian Moynihan and you get other CEOs, Jamie Dimon, all with their happy faces in front of people like you, they're raising the loan loss provisioning. Why? Because they know what's coming down the pike. So I think that right now the recession's been thrown out, I think, prematurely. Bonds have reacted to that. Stock market was throwing out the recession call. Now it's paying attention to the run-up in real rates that Ed was talking about. Yeah. But I think that, this all reminds me, I'll tell you, it reminds me of the summer of '07. Rates backed up sharply. Everybody was saying, where's this recession? Recession started in December of '07. I was sitting here probably with you in June and July of '07, and you were talking about how the hell did the 10-year note ratchet up to 5.35? And then the next, a year later, we're down to 100 basis points. So the worst thing to do right now is extrapolate what's happened in the past couple of months in the bond market. So what are you asking me? I'm saying I'm buying into this. Buy the dip seems to be just a refrain safe for the stock market, buy the dip. Nobody ever says buy the dip. The price dip in bonds. You know why? Because bonds just aren't sexy like stocks are. But I'd be buying into this. I would be adding more fat coupon yield into the portfolio right now, and I think it's going to pay off in the next 12, 24 months.